This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Thank you for joining us. I'm Gord Long. It's my pleasure to have with me again this month Ms. Shedlock of Sitka Pacific Capital and of well-known MISH'S.com. Welcome back, Mish.
Pleasure to be on the show, Gordon.
Lots to talk about, Mish, so I want to jump right in. I guess we should start with FOMC meeting yesterday, Janet Yellen, 3 rate increases that came out of that we should be anticipating. And you had a reader write you, in the last week, and he said, he was asking you why you weren't expecting 3 rate hikes. And it isn't so much he was right, but your response to him was you were really concerned that eventually this euphoria with Trump was going to some realities were going to set in, and that's because of the whole global economy. Comments on that in the FOMC direction?
Yeah, the only thing that was a little bit surprising out of there was the dot plot changed. And what was interesting was in the dot plot, by the way, is they do a survey of everyone who participates in the FOMC. You know, how many hikes do you think we're going to have next year in the next 12 months? And the number of hikes raised up a little bit. Yellen tried to downplay it. It was almost as if, well, you know, we were really at 2.5 before, and now we're at 3, something like that. She didn't say those words, but she tried to, say, but the market really took off on that. And I can hardly find anyone who doesn't think there's going to be 3 hikes next year. I don't. I'm not convinced at all. In fact, I would be surprised if there's more than 1 personally. So we'll see. Maybe they get in another one. 2 years ago, they said there was going to be 4 hikes, and there were 0. Last year, they said there were going to be 4 hikes in 2015 or 2016, and there was 1. And now here we are again next year. Well, they've got it down to 3, so they're expecting 3 hikes next year, and I'll be surprised if they get in more than 1 personally, and none wouldn't surprise me at all. The retail sales were not very good this last month. Autos were down 0.5%. GDP now, the Atlanta Fed GDP model came down to 2.4%. We'll find out on Friday what the New York Fed nowcast says. Probably going to be in the same general area of around 2.4%. But we've also got housing numbers coming out on Friday.
Even the flash reports are showing inventory, like we're stockpiling. We're building inventories, and I'm concerned about the autos because I think there's a real serious slowing in autos, and the inventories are building. And residual values for all these leases coming back are not there. This rings of the housing bubble problem with the values of housing.
It does. The surveys came out today. The biggest inventory build on record. Quite amazing. Meanwhile, this was also interesting. Input prices are rising, but output prices aren't. So there's no purchase or no pricing power here from the manufacturers. They're hard to press to hike the prices of their product, yet they're the most optimistic in 5 years on the New York Fed. In 2 years on the Philadelphia Fed manufacturing reports this week. So a lot of optimism. And what it is, everyone's optimistic now here over Trump. You know, he's got them convinced he's going to save the global economy, Gordon. That's what they're optimistic about. So that assessment doesn't mean a hill of beans. And in fact, if you look at these manufacturing reports, optimism has generally been a contrary indicator. When we've seen strong rebounds in manufacturing is after they've thrown in the towel and sentiment is negative and they don't think it's going to improve. That's traditionally when manufacturing bottoms. Here we've got, manufacturing allegedly bottoming when everyone's euphoric. I don't think so. And then we have seen in just the last month, actually, interest rates rise about 1 full percentage point. That's got to impact housing at some point, in my opinion. We'll see. It might not be this month. Maybe there's a flurry of buyers saying, we'd better buy now before prices go up anymore. But once that's gone, if that happens at all, which remains to be seen, we'll have an indication on Friday with a housing report. But where to? That's what I keep asking. The other interesting numbers that I reported on this week, Gordon, was when I looked at the sales figures. General merchandise stores down 6% year over year. Wow, that's a lot.
But look at Amazon sales, right?
What was that?
What was
look
that?
at Amazon sales.
And
they're actually net up there.
Non-store, which Amazon is a huge chunk of, 30 or 40%, something like, is up 11%. So the other thing that's been fueling the economy over the past several years is a build-out, a proliferation of all kinds of stores, of eating establishments, of Walmarts, of big box stores, all that kind of stuff. Just a huge build-out for what? For sales that are going down and people buying online. So but it takes merchandise to stock those stores, and it takes you got to hire people to staff those stores. So that is one of the, big reasons behind the inventory build. And I think that's going to reverse.
We've overstored in America. That's a fact. To a monumental proportion. We've got everything going online. Amazon is a perfect example of the degree. Now we got real estate, our mortgage rates going up. Think of what this means to commercial real estate. And I'm talking specifically retail space. We've had 8 major chains all shutting down, huge numbers of stores. At some point, I know I drive around up here in New England. There aren't many office buildings or plazas. There aren't big signs for lease, for rent, and empty spaces. And it seems to be getting worse. I think there's a crush coming here.
I think so too. The whole issue with the strengthening dollar, we've got a crisis in Italy that is just absolutely waiting to happen. They've got their 4th technocrat government in a row, and guess what? They didn't change anything. People thought they voted this thing out. They voted for change. They took a clone of Renzi and put that clone right back there in office. And his number one mission, actually, and they even talk about it openly, is to change the rules so that the 5-star movement, which wants to hold a referendum on the euro, can't even get into government. But the real problem here is of the 4 top parties in Italy, only one of them wants to hold on to the euro. So it's just a matter of time here before a coalition builds and says, to hell with this all. We're going to float a referendum on whether or not we want to stay on the euro. And people are mad, and Italy leaving will break the eurozone. Break it.
Well, I think don't underestimate 5-star and Pepe Grillo and the magnitude of the momentum that they've got going, and the other parties. There hasn't been any kind of election, and I'm talking about at the regional city level, that they haven't been winning. So it's a real issue. But going back to, some of this inflation and the speculation, you've been a hawk on whether our concern of a possible global deflationary bust. That may be too strong, but it's there. I noticed in Switzerland they're fighting deflation. You've thrown out a challenge to the Keynesian about deflation. We got this mantra as though deflation is bad. Is it?
Well, I posted charts on this from Switzerland. I said, so I showed prices in Switzerland going like this, and I showed unemployment also going down as well. So the question I asked here is, I said, more people are employed. Their money buys more, not less, and you have economists whining about it. The Econo Day is among the worst. I mean, they whine about this all the time, but they're all alike. I mean, not all of them. Certainly the Austrian economists, the rare ones you can find, have a different take, have a correct take on this. But even the Bank of International Settlements, came out and said, even exports can go up in this kind of situation. What's really damaging, and I've talked about this so many times, but it's worth harping on because people still don't get it. And they still don't get the benefits of free trade. You just got to, so I keep hitting back on these same themes over and over and over again. Deflation isn't bad.
You are a lone wolf on that, by the way.
Pretty much.
Nobody's
right
saying that. Everybody kind of says deflation is bad. Asset deflation is bad for financing, but it's not bad for people and a consumer, especially that's tapped out.
Well, asset inflation is really damaging to banks. Why? Because they take all they loan on assets. That's what they do. They take a collateral of a house. We saw this happen in the Great Recession. And, guess what? People walk away from the mortgage and the collateral of that asset, the house, or the value of commercial real estate, as we're talking again here now, that's gone down. So and then banks get impaired and they can't lend. So it's asset bubble bursts. And the stock market plunges, people get scared, they buy less. How do you fix this? Well, you don't blow the bubble in the first place. And the Fed has blown, central banks in general, really, not just the Fed, have blown serial bubbles one after another after another. I would not have thought we would have reblown this bubble this fast, but we did. Thank you, Ben Bernanke and now Janet Yellen. And they still don't see, what's coming here. They don't. Meanwhile, stock market keeps making new and new highs. Valuations keep soaring to the moon.
Yeah, but the Venezuela stock market and the Zimbabwe market are making all-time record highs too. Don't confuse record highs in a market with underpinnings that are solid economics.
Yeah, the problem now
we're talking currencies. I've shifted a little bit.
The 100 Bolivar note, and they're comparing this to Australia banning the $100 note. These two things really have like nothing in common. Venezuela almost needed to get rid of this $100 Bolivar note because the damn thing is worthless. The 100 Bolivar note is worth 2 cents on the black market. It probably costs much more than that in ink and paper than the damn thing is worth. But people literally carry stacks of these things just to buy routine items like toothpaste. It takes this is exactly what happened in Weimar, Germany. It literally takes wheelbarrows full of these things to buy anything.
We're talking about monetary malpractice, and you kind of alluded there about the war on cash. Comments on what's going on in Australia and India regarding this war on cash?
Well, they say they do it. They're going to stop money laundering, blah, blah, blah. Really what they're doing, first off, they're after tax revenue. They want to know where every penny goes, where every penny went. And my friend Pater Tenebrarum at the Acting Man blog pinged me in response to this article that I wrote about them banning the $100 bill, and it's $1 in Australia. And Canada, so the $3 currencies. There's probably some more. Anyway, so they banned this, and Heinz goes. Patter said, "Well, let them, let them." He goes, "The underground economy is far bigger than anyone thinks. These politicians don't understand, the plight of these people. We saw a huge cash drain in India over this." And then I started thinking about, some things. Okay, so let's say we ban cash. I want to hire the neighborhood kid now to mow my lawn, so I hire him for $10. Is he my employee? Do I have to pay Social Security tax on that? Is he a private contractor? Does he need his own business ID to mow my lawn? Batter didn't even get to those points, but that's just one of the implications here. I was thinking, so they cracked down on this underground economy. He speculates the tax collection's actually going to go down because these people aren't going to have money. They won't be able to spend. And this is what we're seeing happen in India, by the way. And they think things are going to get back to normal here, just as soon as this all settles down. It might take a lot longer than anyone realizes for this to settle down. And this is, what you're getting here. And what we really need is to let the free market decide what money is in the first place. I'm sure they wouldn't settle on money that can be conjured up out of thin air. You give someone a choice. Whenever given a free choice, the market the consumers have universally wanted gold. We have dollars and yuan and Swiss francs and all this simply because governments mandate taxes be paid in those local currencies, creating an artificial demand for them when otherwise people would have gold.
Switching gears, Mish, we've talked about all the pension issues in Illinois and the city of Chicago, but Dallas and Fort Worth and the police fire, some real problems there that stem from initially bad investments in real estate. And comment?
Well, they do have bad investments, but it stems from promising 8%, in a 2% world. So the fund managers have to go out and do all kinds of crazy things. A lot of people have talked about Dallas. I mean, I put a spotlight on Fort Worth. What happened in Dallas very briefly is they acknowledged the pension plan was way underfunded, and Dallas allowed people to pull out their money in lump sums. We literally had a run on
by police taking early retirement to get their money out before it went broke.
That's exactly
so they had
correct.
To stop them from
had this gone on even one more week, the fund would have blown up. Now here it is. It's still, I don't remember what percentage funded, but let's call it half for the sake of argument. How are they going to make that back? How are they going to get that back? Even if it's 60% funded, how are they going to get that back? I didn't look at what the Dallas pension fund was holding. However, I did. Someone sent me an online link to the Fort Worth pension plan, and I did some diving around in there. And my gosh, a huge percentage of the assets were in BBB and below rated bonds. BBB is one step above junk.
Remembering they legally can't go to junk. Okay, by the nature of their pension plans, typically a normal.
Oh yeah, yes. I mean, nothing stops these bonds from going to junk, but some pension plans, can't hold junk and would have to sell them. Fort Worth wasn't one of them because they had a whole stack of stuff all the way, down invested in stuff that was near default.
So the question, Mish, is this unique to Dallas and Fort Worth, or is this just a canary in the coal mine and we've got this right across the country, police, fire, teachers unions, because we know the degree of underfunded pensions?
Well, we know Illinois is they're on average about 40% funded or something. It's probably way less than that because they're probably, I know they're making it look as good as they possibly can. And if the best they can do there is come up with 30 or 40% funded, it's a lot worse if they threw some real numbers at that. And by the way, that's with the same type of assumptions here. I think Illinois is, well, it varies from plan to plan, but it's like 7.75 to 8%, maybe one of them 7.5, and one of these funds, I forget which one, is only 20% funded. So when I say on average, they're really god awful, waiting to happen. So there's going to be some lawsuits over this. They did lower the pension payment over what has been promised, and people demand what they're promising. Well, what if it isn't there? You really expect taxpayers to kick in $1 billion? The pension fund actually asked for taxpayers to kick in $1 billion, and guess what? It wouldn't have even made the fund solvent. Wouldn't even come close to making the fund solvent. So this is going to blow sky high as soon as we have another decline in the stock markets.
And we've never been at higher valuations than we currently are in the stock markets. But it can go on. We don't know. But at some point, you would think it.
Yeah, there were higher. I think we've taken out the 2007 valuation here now.
Schiller PE.
The median is the worst, I believe, in history. Median PE. When you look at the indices, the dot-com bubble was bigger, actually. You had all kinds of companies with zero earnings and never stood to make a dime. But if you just look at the median corporation now compared to the median company in 2000, we're a lot worse today. So you really have to go back to the Great Depression to find valuations as stretched as they are right now. Only a couple of times in history. And the weird thing is, we've been saying this for 2 years, and the valuations keep getting more and more stretched, and stock prices keep going up in spite of the fact that earnings aren't even going up anymore. So it's a really toxic brew. But everyone's convinced now that Trump is going to save the global economy, but I'm going to tell you here right now, he's not. He's not going to create any jobs. He's not going to even bring back any jobs. Manufacturing might come back. It already is, in fact. Jobs aren't coming back with it. This is not about NAFTA. This is not about China. China's losing manufacturing. It's about automation. And we've got some, and Janet Yellen was harping about productivity again, waiting for productivity to going to go. When it does leap, and it's going to, they're not going to like the results, because the way it's going to leap is with driverless trucks and cars, and it's going to put millions of people out of work. So, I don't say this lightly. Some people think, that I'm way wrong, that these self-driving cars and trucks aren't coming, and I think my timeline of 2022 to 2024 now is actually way too pessimistic. It's likely to happen much more than that. The average consumer might not buy one of these cars for themselves.
No, I don't think it's a consumer. It's going to be commercial drivers, truck drivers, delivery. That's the issue. Because I saw maps that showed what most employees were 10 years ago, 15, and then today by state. Truck drivers in every single state are a dominant job description.
Yes.
And that's what the target is.
Jobs are going to go away in a big bang, over the course of a year or two at most. These jobs are just going to vanish.
Now they are pushing that hard to get this technology in and implement it.
The Department of Regulation, the state of Michigan allows the sale now, first state. of cars without steering wheels or brake pedals to consumers. So testing is underway there. There's a lot of competition in this arena. Google, Apple, all the car players are in on it. The states are fighting, between each other, to see who can come up with the most friendly testing rules and regulations. So, it's really quite something. Yet, a lot of readers of my blog just think I'm wrong and don't think this is coming.
Time will tell. Mish, we have to kind of wrap here, but I'd be amiss if I didn't. Could you kind of give us what you think the major themes are going to be for 2017 in your mind? The things that you're at least focused on?
Well, the themes are 3 hikes, which I don't think are going to happen. The themes are a stronger dollar, which I don't think is going to happen. The themes are weaker gold, which I don't think is the action. And in fact, I would bet against all of the major themes here. It's been a very dangerous market to short. So I've not recommended shorting, and I'm not recommending it now. But my viewpoint is that's likely a winner, Gordon. So my themes are, just do the opposite of what everyone else seems a near universal expectation that Trump is going to create inflation, create jobs, save the global economy. I don't know. I just have this feeling we're on the cusp, but I've been there for 3 years now, with stretched valuations becoming more and more stretched. So a little bit of caution is warranted here. But in spite of this huge smackdown in the price of gold and silver, the miners have actually held up relatively well. The declines have been relatively orderly. There is demand out there. I'm just waiting for this catalyst, which might just be sentiment, anti-gold sentiment, just totally burning out. But someone asked me just yesterday, because I made those statements a couple of days ago, and guess what happens? The dollar soared to new highs, and someone said, did you change your mind? As what's changed? Trump's got a mess on his hands. The global economy's got a mess on his hands. I think some of his policies are going to get into a global trade war. And from where I sit, and also looking at the situation in Europe with Italy, it doesn't look politically good either.
Got to wrap, Mish. I wish you a happy holidays and a happy new year, and all the best.
Oh, and the best right back at you, Gordon, and the best to our listening audience out there. Thanks for tuning in.
Talk to you again next year.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.